All right, now we're going to fill you in on the mysteries of debits and credits here. So exactly what is it we're talking about here? Now, understand this. The reason we're implementing a new rule here is because the accounting equation is just simply unworkable for day-to-day transactions. It's terrible. Because again, some companies, I gave you an example where we had, 10 different accounts working, and that's just an incredibly small number. Some companies are going to have, again, thousands of accounts for consolidated entities is not unheard of. So what we're doing here is we're creating a secondary rule, this debits and credits rule, and this is something I came up with, that supersedes the accounting equation while simultaneously maintaining its integrity. So in other words, you don't have to worry about the accounting equation anymore. You just follow this debits and credits rule, and the accounting equation's equality will take care of itself. So that's the beauty of what we're doing here. All right, so we're going to look at the chart of accounts that we just talked about in the previous video. And we're going to put everything here in a new form. So it's going to be some material you've seen before, but just taking on a new shape. That's going to be referenced to supplement page 2 from my handouts. I'll just go one slide over. There we go. So this is what it looks like in your notes. And what I did here is just simply, I took all the chart of accounts on the chart of accounts, except for the miscellaneous expenses account because it wasn't using the original example. So if you look here, this is actually following the accounting equation in terms of organizational principle. In other words, I put all the asset accounts on the left-hand side of what you're looking at, and that's why I added an equal sign here just for clarity. And then all of your liabilities and owner's equity accounts, which also includes all the subclassifications of retained earnings, are all on the right-hand side here. Now, what's the importance of that? The importance of that is understanding what we're going to do as far as how are we going to account for the numbers in any one specific account. Now you'll notice every account here has a T underneath it. I will draw along the lines here just to kind of exemplify that idea. So there's your T. So when I talk about a T. Now of course, what's the beauty of a T? Natural right and left divide. Now you can just see it right there. So the rule we're going to have to do is we got to pick a side. Right? So we're going to pick a side where we're going to keep the numbers for a specific account. Now again, the rule we're going to follow is simply this. Whatever side of the accounting equation we're on is going to determine the side that we're going to put the number on. So that's why all of these asset accounts here, that's what you're looking at. These are our 4 asset accounts. Since they were all, again, the assets are on the left-hand side of the accounting equation, they'll be on the left-hand side of the T. So you'll notice every one of those, there is a plus on that side. So that side you see the plus with is called the normal balance side, just like it sounds. It's where we normally keep the numbers for that account. So if we want to look up the number in cash, we'll look on the left-hand side of the T. And this is more of a learning tool, these T accounts that we're looking at here. You wouldn't do your day-to-day accounting in this, but this is just sort of a stepping stone to get us ultimately to what we're going to do. Right, so all those pluses, that's the side we normally keep the amount for that, and it's also the side where we would add to an existing amount. So if we want to say we have more cash, we would put that number on the left-hand side of the account, and then we would add it to the existing balance. Now you'll notice the T accounts, this form, we don't update any numbers. We're just slapping numbers on one side or the other, and that's all there is to it. For how it's going to look in practical terms, we have to look to something which is in a later video, later handout, called the later part of this handout, actually, in terms of my class notes, which is going to be called the general ledger. So that's where the actual numbers would actually appear in the system. Right. So if we have a plus side, that means we must have another side, which is the minus side. In other words, if you want to indicate you have less of something for your assets, you put that on the right-hand side. So that's why you have to have one of each. One to say if we have more of it, put it on that side. And if you want to look up the number, look it on that side. So that's the left-hand side for your assets. If we have less of these things, these assets, we put that number on the right-hand side. That's a subtraction side. So you'll notice what this does, this debits and credits rule will do away with the need to put anything in brackets or indicated negative. Negative is positional when you think about it. If you want to know if something has a negative impact on cash, you'll see what was it on the right-hand side of the T in this case. And if so, yes, that was a subtraction from cash, for example. Same thing with accounts receivable. See it on the right side, that's a subtraction from accounts receivable. So the negative is positional, same thing with the positive. All right, so that was what was true on that side of the accounting equation. So now when we go to the other side of the accounting equation, So now we're on the liability owner's equity side, and I want you to just focus on everything above here for now. In other words, anything below retained earnings, don't worry about it for the moment. We'll discuss that shortly as to exactly what's the normal balance rule for everything that is a subset of retained earnings. So since we're on this opposite side of the accounting equation, we're now on the right-hand side of the accounting equation. Guess what's going to happen? The normal balance rule is going to change as well. So remember, the first rule we discussed for assets was based upon where was it in the accounting equation? Left-hand side, so these are now on the right-hand side, so same idea is going to apply. So now the plus side for all of these accounts is the right-hand side, because why? Because they're on the right-hand side of the accounting equation. That's it. That's the total logic there you're dealing with. So that means by default, now the left side is going to be the negative side for these accounts. So using this left equals right, because that's the rule that we're going to first start with here before we delve with debits and credits exactly means. So that's the rule we're going to look at. So we're going to do the first transaction in this format here, which of course was what? Was the investment transaction, the issuance of 50,000 shares of stock for $1 million cash. I'm just going to look at how it would appear in this, in this format here. So it would be like so. So you'd have more cash, so that's going to go on the left-hand side of cash. And then you have more common stocks. Remember, it was an investment, so we're going to have to use a common stock account. We'll put that on the right. So again, to repeat, that means the rule that we're enforcing here is just make sure all the numbers on the left equal all the numbers on the right. Simple as that. Now, before we go through the rest of the transactions, we're going to have to go over what's going on with the accounts down here. That was the magic of the pause function as to why all that stuff just disappeared. I need to use that more often, but this is all new to myself, so we're learning together. Think of it that way. So what's going on with those? Well, just as a quick refresher, remember all of these accounts down here are all subsets of retained earnings. So let me go one slide over just to go back to something you've seen before. So that's how they were originally displayed, right? So there was your fees earned, your repairs expense, dividends, supplies expense. So they were all subsets of retained earnings. Now notice, what was the impact of these individually on retained earnings? Fees earned increased it. Repairs expense, dividends, and supplies all did what? They all decreased it. So I said all had that in common. So that's important to keep in mind. So this is the way to think of it as. If we were going to record, let's start with the revenue account right here. We're going to record fees earned directly in retained earnings. Which side would it go on? Okay, so go back to what we just saw. Retained earnings is increased by fees earned because there's our plus. So therefore, which side is the plus side for retained earnings? It's that side, it's the right side. So in other words, when we break out retained earnings as a separate concept, its normal balance rule is going to follow the normal balance rule of retained earnings. So that's where it gets that normal balance from. It's based upon what the normal balance of retained earnings was. It all swings back to that. Now, again, same logic here. If we were going to directly record the repairs expense, dividends, or supplies expense directly in retained earnings, which side would it go on? Again, they're all negative, so what's the negative side of retained earnings? That would be the left side there, right? So that's going to be your negative side, so that means their normal balances are going to have to be consistent with that notion. That is that if we directly recorded them there, it'd be on the left side, so that therefore when we break it out separately, normal balance is the left side. But remember, by definition, normal balance means what? Plus side, right? You can't have two negatives. Can't have two negatives. And I want you to keep this in mind. When you're accumulating revenues, expenses, and dividends, all you're saying is you have more of these things. You're not commenting on what the impact of them is on retained earnings. You know what the impact is. We've already discussed that. Dividends and expenses will subtract from it, and the revenues will increase it. So that's clearly established. So just keep in mind what you're doing here is you're just saying we have more dividends, more fees earned, more repairs expense, more supplies expense. So don't worry about its ultimate impact. We already know what that's going to be based upon what we just discussed earlier. And this is important as well. You can't have two negative sides or two positive sides on an account. Why? It doesn't work in accounting, and it also doesn't work in nature. Okay? Because all the atoms in the universe have what? Well, there's technically three things, but we don't care about neutrons in here. We just care about protons, positive, electrons, negative. That's it. So that's the way to look at it. Every account you have has a proton side and an electron side. Positive side, negative side. Doesn't matter what we're talking about. That's just the case. That's the way it is. It's just there's no other way to address it. So again, you will ultimately see dividends and expenses will be a negative impact on retained earnings as well as the positive impact from the revenues. That'll happen eventually, but just not now. When we get to something called the closing entries, you see how that works. In other words, eventually we're going to take those subset accounts and we're going to put them in the retained earnings account after we actually get to the end of the accounting period. That's ultimately what will happen there. All right, so let's do the remaining transactions here, 2 through 10. Again, cleaned up again. Poof. All right, so transaction number 2 was what? Purchasing those 10 trucks for $250,000 cash. So that necessitated them having to say that we have more trucks, so that's going to go on the left-hand side of trucks, and then the offset is to say that they had to surrender cash to do that. Now again, in a normal setting here, business setting, what would you see? Because there was $1 million in the account and we just used up $250,000 of it, they would update that balance so that it would now say $750,000. So that would be the reality which you're really going to be working with in an actual accounting setting. All right, number 3 was purchasing supplies on account in the amount of $3,500. That was more supplies put them on the left, and of course they owe more money, so that goes on the right-hand side of the accounts payable, the liability account. Transaction 4 was providing services for a customer in the amount of $50,000 on account or on credit. Remember, that was the important point because that tells us why. Why is that important? It tells us it goes in accounts receivable as on the left-hand side there, and then we're going to say, well, we have more revenue, so that goes on the right for fees earned. Again, just following left equals right for every one of these. Number 5 was another revenue, this time for cash. Again, if it doesn't say that they paid cash, you just have to assume it. So that would mean they have $15,000 more cash, so put that on the left-hand side for cash. And once again, this is earned because they provided services, so we have to put that on the right-hand side for fees earned. And now transaction 6 was doing some repairs to the trucks, right? Routine maintenance, $5,000. So that means that they incurred repairs expense in the amount of $5,000, put that on the left-hand side for repairs expense, and then they had to surrender cash, so that means cash went down by $5,000, put that on the right. Number 7 was paying off the liability, right? So they extinguish that liability so they can say, well, guess what? It doesn't exist anymore. Let's put that on the left-hand side because we're subtracting from it. We're also subtracting a like amount from cash, so that goes on the right-hand side for cash. So see, all the negatives take care of themselves. We know positionally this was a subtraction from accounts payable because it was on the left-hand side. Likewise, we know that these are all subtraction from cash because positionally they're on the right-hand side of the cash account indicating a negative. Number 8 was our customer that owed us $50,000 paying that amount off, so we have more cash, put that on the left-hand side for cash, and then put that on the right-hand side for accounts receivable to indicate that, guess what? They don't owe us that anymore, so that's subtraction from that. Transaction number 9 was we paid $25,000 in dividends to the one owner, Mike Nelson. More dividends, put that on the left-hand side there. Had to use up cash, so put that on the right-hand side for the cash account once again. Lastly was recognizing supplies used in the business were $2,500, so that's again incurrence of an expense. More supplies expense, put that on the left-hand side for supplies, and of course supplies dwindled by $2,500, put that on the right. So you'll notice all the balances we have here are all equal to the balances that we observed in the original example from the beginning video there. So there they are, see, all the same, right? Everything is the same here. Now you'll notice here's the big difference. All these negatives here, right, because we were indicating their impact on retained earnings, right? So that's what these numbers indicate, is saying, oh, these are all negative for retained earnings, right? So that's why I had to show them as a negative. But now in this form, we can just look at those same balances and say, oh, we know that $25,000 is going to have a negative impact on dividends, because if we were to move it here, guess what would happen? It would end up being a subtraction. Same thing with the repairs expense and supplies expense. If we move them to there, which we could, if you think about it, just do what? For dividends, just put $25,000 on the right-hand side, and then the offset would be a $25,000 left-hand entry for retained earnings. And that's essentially what the closing process is going to more or less look like. It's just transferring those numbers to retained earnings, so the impact that they'll have there will, of course, be negative on them. So it's going to happen, just doesn't look obvious at first. Now, the rest of this saga will be continued in the next video on debits and credits. Again, a little bit of a cliffhanger because I still haven't really given you the, hey, where's the debits and credits figure into it? Stay tuned for the next video. See ya.